All right, beautiful. So this was static risk, right? So static risk is where we manage risk as price goes in drawdown. As price goes in drawdown, that's when we manage risk. So next, what we're going to talk about is dynamic risk. Don't forget to record yet, no problem. Dynamic risk. Dynamic risk. That's what we're going to talk about now. Now, dynamic risk is when you initially start off with a smaller risk amount. Let's say you have, let's say, for example, you have 2%. Let's say you have 2% risk. Now, what you're trying to do is you're like, okay, price is at some sort of a resistance. We're coming down. So let's say we're coming bearish. We come up to create resistance, and resistance is formed when you have a bearish candle forming after a bullish candle. So when you have a bearish candle formed, now you're thinking that, okay, I'm going to take a sell over here, but instead of using my complete 2% risk, I want to break this down into two 1% risks. Make sense? So we're going to drop this down into two 1% risks, which now essentially means that as soon as the new candle starts, you're focusing on a sell and you're using 1% risk at this point. You use a 1% risk, and now you're anticipating the next candle to move down. Now, there are two scenarios that can happen at this time. As soon as you deploy your 1% risk over here, this current candle can continue to push down, and you're only in it with 1% risk. Or what can happen is that the next candle can probably continue to move up to create a top wick, which at that point, you're going to enter another 1%, which total now you have 2% risk involved in the trade, and now you're anticipating the next candle to continue to push down, right? So you're breaking your risk into two parts. So let's say, for example, instead of using full-on 2%, you want to use a full-on, let's say, 1%, and now you're going to break this 1% into two 0.5% risks. For example, let's say you're using for example, you're using two lots, right? Two lots to take a trade. And what you're going to say is that, okay, instead of using two lots in one go, you're going to use one lot as soon as the new candle starts. So this is your one lot goes over here. And as the next candle starts to retrace, you enter your second one lot at this point, so to speak, that the next candle can continue to push down. But the most important thing is going to be your stop loss. Your stop loss will always remain the same. Your stop loss in a sell will always remain above the previous candle. So that's where your stop loss is going to go. So even let's say you have only one position open and that position continues to move down, you have one lot in, your stop loss remains the same. If let's say price continues to push up, you enter your second position, your stop loss remains the same. That's it. Your stop loss remains the same. So this is how you're using dynamic risk, right? Essentially, if your price does come up and hit your stop loss, you will lose 2%. You know, that's the downside about using dynamic risk. So there are two scenarios. Scenario number one is adding position on retracement. This is where you lose full risk, right? Scenario number two that we're going to talk about now is, for example, let's say we have this resistance, price is coming down, moving up, and you know, you got your bullish candle here, and then you got your bearish candle. And now you're trying to take a sell. You take a sell of 1%. So when price moves up, you don't care. You don't enter any risk. You don't enter any trade because you've entered 1%. Now total risk is going to be 2%. Now, as soon as then this new candle starts to break the low of the previous candle, you're like, okay, you know what? We've made the top wick right here, and now we're coming down. We're breaking the low of the previous candle. Boom. That's where my second entry is going to go. And you're going to put in another sell right here because we've made a top wick. We're breaking the low of the previous candle. So now there's a higher probability for price to continue pushing down. And then we start to push down, and total risk now becomes 2%. Your stop loss remains the same, right? So let it digest here a little bit. Let me explain this again. First scenario was when you were adding risk back to the trade as we were retracing, as the candle was moving against you, right? As the candle was moving in the opposite direction, that's when you were adding risk to the trade. But when the candle in the second scenario, what you're doing is you're adding risk to the trade. So let's say you're taking a sell 1%. This is where you're adding the first sell, and as price moves up, you're not doing anything. That's it. You're letting it retrace. Because for all you know, price may retrace all the way up to stop loss. And we don't want that. Guys, keep your questions to yourself. I'm in a flow zone right now. Let me be in the zone. Right? As price retraces, it's going to hit your stop loss and you're going to lose 1% instead of losing a full 2%. Now, what happens is if you don't do that and you're like, okay, you know what? I'm going to wait for price to retrace and I don't know, and I'm not going to do anything. I'm not going to execute. I'm not going to plan my risk. I'm not going to enter another position because you already entered 1% at this time. So now what you're saying is I'll let price retrace. And it's like, the fuck, man? Oh, it's my wife. I got to answer this. Okay. Okay. So you entered 1% right here. So now you're anticipating the next candle to continue to push down. As it starts to break the low of the previous candle, you're entering the second risk at this time, making your full risk to be 2%. So in this case, you're still safe. Even if you do lose, you're not losing the full amount. Even if price goes in like, you know, a drawdown, you still have one position that you can close and you can leave the rest running, right? So scenario number two becomes when you add, whoa, when you add position as price goes in your favor. That's when you add the position as price goes in your favor because now there's less risk. You know, so I very, very, very rarely add positions when price goes against me. I only add positions when price goes against me when I'm 100% sure. 100% sure that this is just going to be a retracement as long as the candle does not break the high of the previous candle, right? If you're entering on, let's say, if you're entering on, if I gotta write these notes, if entering on retracement, make sure the previous highs or lows are not broken. I have a very beautiful handwriting, maybe because, I think too fast and I write too slow because the highs and lows are not broken. Wouldn't we put the stop loss at the bottom of the current wick once it is formed? Stop loss at the bottom of the current wick? No. Once it formed, like it forms or it has formed. The two differences. It's still open and it's forming, or has it closed and formed? There are two differences. Would there be a certain condition to use dynamic risk? Because it's just down to your personal preference. It's just down to your personal preference whether you want to use dynamic risk or you want to use static risk. I use static risk because that way static risk gives me the flexibility to manage my risk. That's why I use static risk. And dynamic risk, you got to add positions and you got to remove positions, and then you can't manage risk because you've already entered a smaller position. The biggest issue the biggest issue I saw with people was that, like, they would use dynamic risk, and let's say price would come up towards a resistance, and then there was a bearish candle formed. So what they would do is they would basically take a sell. They would take a sell, which would be 1%, right? And then price would come up to their stop loss and they would get stopped out, right? So that was a very small issue. The second issue was that if they would take a sell and if they would say, okay, you know what, I'm going to enter on a position once it retraces, but it didn't retrace and price just continued to push down, now they're only in the trade with 1%. And they're like, oh, I can never make big profits because I'm using dynamic risk and I'm only making 1%, but instead I should be making 2% or 3%, like my normal risk. So this is the reason why I don't use dynamic risk. I only use static risk, because if this is, let's say, 2%, and let's say we're using static risk, right? Even if price goes up on the smaller time frames, I can manage my risk. And if price goes in my direction, then I can make the same amount of risk as trying to profit off of. So static risk, I think, is way better. It's way easier. Dynamic risk, it's a little bit difficult, right? And very quickly it can get very risky as well, because as price retraces, our brain goes in overdrive and we want to say that, oh, okay, what, we are let's say we are retracing, so someone may add a sell over here. Actually, let me just move this. Yeah, let me move this right over here and remove this, right? And someone might say, okay, I'm going to add a sell over here, and then I'm going to add a sell over here, and price retraces and they add another sell over here, saying that now my stop is going to be tight. So now I have 1, 2, 3 sells open at the same time. And then if price goes in my direction, I'm going to make a lot of money. But then there's going to be a higher probability you may hit your stop loss, or spread hits your stop loss and you get stopped out. And now you've lost more than you anticipated to lose. So I always aim for static risk. I very rarely go for dynamic risk. So any questions so far based on dynamic risk and static risk? Dynamic risk and static risk. It's very simple. Static risk, you're taking risk off of a position as the candle closes against you. That's it, right? Dynamic risk is when you are using a smaller percentage to begin with, and then you're adding position to the trade as it goes against you. That's the first scenario, which we discussed right here. And then the second scenario is that you're adding position to the trade as it goes in your favor. So one, you add position as it goes against you. Second, much safer one, is when you add a position as price goes in your favor. So two levels of dynamic risk. Stop loss on the break of the previous. Stop loss on the break of the previous if the current candle, second candle. Break of the previous of the current candle, what? Stop loss on the break of the previous. What are you trying to ask? So the stop loss is going to be based on the previous candle. Yes, if that's what you meant, right here. That's where the stop loss is going to go. Having the stop loss up over here is going to be risky because the next candle can come up. I mean, this can retrace and stop you out. So that's risky. Which one will help to get confidence quick? I'd say static risk. Static risk is going to help you to get confidence quick. Static risk makes much more sense. Safe, it's very, very safe. Very safe and very sound. Static risk. We good? Cool. Cool beans. Cool beans. Cool bean. I think static will be better at trusting your trade and analysis and better to manage risk. Yes. I found out the static risk is way better to manage risk. You get better over time. Dynamic risk is just a bunch of problems in the end. Okay, perfect. So next, what we're going to talk about now is going to be how to add risk back to the trade, right? So we talked about when to take a risk off of the trade, which was in static risk right here, that price closes against you, you take risk off the trade, and like, now what to do if a scenario happens, like this, where candle goes in your favor. Candle goes in your favor, how to add risk back to the trade. So we're going to discuss this here now. Okay, so how to add risk back to the trade. Can I ask TPs 10 pips or 25 to 30? That depends on your trading plan. Like, what are you trying to get? 10 pips, 20 pips, 30 pips? What are you trying to get? All that depends on your trading plan and how you see things fit. Okay, depends on how much range you have. Yeah, exactly. Also depends on how much range you have as well. Okay, let's take a look at this now. How to add risk back to the trade. What does this mean? This means that you managed risk because candle closed against you. Because candle closed against you, right? And then you noticed that price went back in your favor. FV, favor, right? You notice price went back in your favor. And a lot of times this happens is that you're going to manage risk, you're going to close 50%, and you're going to secure whatever percentage that you're going to secure. And then you're going to notice that price goes back in your favor. And then you're saying that, oh man, I knew price was going to go. I knew price was going to go. So instead of me making, like 2%, I've only made 1%. So now you're like, oh, like, how can I do that? Or like, when price goes in a drawdown and you close out your whole trade and then you see price goes in your favor. So we're going to tackle that situation and issue right now. So what happens is, let's take a hypothetical example. And this example is going to be something like, a very easy example, like price making a low and then retesting the low, right? Okay, let's say we have a candle that comes down. We have a bearish candle that comes down. We have another bearish candle that comes down. Oh, by the way, it's NY open. Let's take a look at, I want to take a look at what happened over here. Oh, wow, see that? Look at that. The 30-minute candle closed weak bearish right here. The 30-minute candle closed weak bearish. And then what happened? You had this 30-minute candle creating support, and we closed strong bullish with little to no wick on the top. but there was still volume. So we wicked down, and if we wanted to move up, we didn't really break the low of the previous candle, right? We didn't really break the low of the previous candle, and now we continue to move up. News. So there was news. So maybe there was news. That's why we were just consolidating right over here. Yeah. Oh, it went up first. Oh, okay. Yeah, I wasn't looking at the charts. I'm just looking at the candle formations here. I wasn't looking at the charts. What does this do? Oh, interesting. Oh, oh, damn. This is news right here. Okay, okay, okay. Yeah, I was just marking up the chat. I didn't know this. Yeah, it's news right here. Wow, that's crazy. PPI news. Could have made some money over here. Wow, that's insane. What if I take a buy over here? Okay, how do you close this? How do you close this buy? I don't want this buy anymore. Um, yeah, yeah, I don't want this buy anymore. Is it closed? It's closed. Don't want no buys. Okay, let's get back over here. All right, hypothetical speed, right? We're coming down, and then we come on moving down, and now what we want is that we create some sort of a support. And mind you, we are in a downtrend, right? Candle goes up, another candle goes up, and now we have a bearish candle forming, a perfect bearish candle forming right over here. Okay, and let's just do this. Let's make this a little bit lower, right over here, here, and right over here, right? Okay, perfect, right? So now we have created some sort of a resistance. We have a resistance formed, resistance, and this is a perfect situation to take a stop. What's going to be the highest probability that price is going to do? There's a higher probability that the next candle can continue to push down. So what do? You take a sell, you take a sell right over here, and now you anticipate price to continue pushing down. Now, when you're anticipating price to continue pushing down, instead of going down, what happens is that, let's say this is a 30-minute time frame, and you notice that the 30-minute candle, it basically moves down and it closes a bullish candle like this, right? It closes a bullish candle like this, and now you're saying, oh, okay, you know what? What can I do now? You're like, okay, let me close 50%. So you close 50% right over here. Now, as you've closed 50%, your stop loss essentially is above the previous candle right here. And as the stop loss is above the previous candle, you still have the position open. You've closed 50%, and now you're just waiting to see what's going to happen next, right? Now, what happens is that the next candle, maybe it closes bearish like this. And now you're saying that, okay, I have a position open. My stop loss is still up over here. And, a candle has closed bearish now. We have this low to be retested. Now you ask yourself that what's the probability for the next candle to continue to push down? This is where you're giving your trade a second chance, right? Or you're trying to say that, okay, how can I add risk back to the trade? Once you see, let me just pick another color right here. Once you see this confirmation candle, you're like, okay, maybe now this is a great idea to kind of add risk back to the trade. So you sell with a lower lot size, and now you're back into the trade with normal risk, anticipating price to continue pushing down. So essentially adding risk back to the trade and giving your trade a second chance. What you're saying is, you're saying that now I'm looking for a second confirmation trade for price to continue pushing. That's what's happening at this point. Make sense? So what we're going to do is do this here again. And we're going to do this for buys, right? Let's say price is moving bullish. We have buys formed. and price is moving further bullish. We continue to move up, and now the bodies of the candles, they start to get smaller and then smaller, and then you have price starting to come down. This, and then you have price coming down, and then you have price coming down here again. Now you have some sort of like a bearish candle forming, and this is where you get some sort of a support form, just like this. Now you got a support form over here. You got a support form. Now you're telling yourself, okay, this is a great opportunity to take a buy. And this is a 30-minute time frame, by the way, right? You take a buy over here, and the next 15-minute candle, let's say, so if we draw the 15-minute candle side by side, the 15-minute candles are going to look something like this. We have 15-minute candles, 30-minute, and this is a 15-minute candle right over here. So you take a buy, it's the same thing as executing a buy on the 15-minute. What happens with the next 15-minute candle is that maybe we close bearish, right? Once we close bearish, you're like, oh, okay, I attended this virtual class with Raja, and Raja said that when you have a candle closing bearish on a smaller time frame, there's a higher probability that maybe price is going to go against you. So if price goes against you, this means that maybe I want to close 50%. So in a 30-minute time frame, this may mean that, the 30-minute candle is now formed bearish. So you close 50%, right? Now you're 50% out of the trade because you saw the 15-minute time frame right here closing bearish. Now, once you see the 15-minute time frame closing bearish, you're like, okay, let's just see what happens next. And as you're looking at the 15-minute time frame, you look at the next candle, the next 15-minute candle starts to move up, which makes the 30-minute candle, let's say, finish bullish. And the next 15-minute candle starts to move further up again, which means the next 30-minute candle starts to move up. Right? But once the candle closed bearish here earlier, this is where initially you got scared, you closed 50%, and then price went in your position. Or you closed your entire position and you're like, okay, you know what? I'm going to be safe. I'm not going to do anything. And then price continue to move up. And you complain to me or complain to your buddy or complain to people that, oh man, whenever I take a trade, price just goes in my direction. And as soon as I close the trade, price goes in my direction. I don't know what to do. So this is what you need to do, right? You need to identify that, okay, how can I give my trade a second chance? Because most of the times what happens is that we look at price action through a very emotional lens. We don't look at price action logically. Because if we look at price action logically, we're going to start to understand that candles are leaving certain clues in the market. Candles are printing in certain ways that maybe if we gave them a second thought, we may start to understand that, okay, maybe this means that price may continue to go in my favor if I don't change my bias, right? Let me write this down here as well, because some people don't really remember this. Never change your bias. Never change your bias. You have to keep the same bias for this strategy to work. If you think price is going to go in your favor, if you think you're going to give price a second chance, you should never change your bias. Right? So now you close 50%. Once you close 50%, you're looking at this and you're saying is that, okay, once I've closed 50%, and if the candles is breaking the high or we're closing bullish here again, maybe this is where I can re-enter and let the trade continue to run. So that's where you're giving your trade a second chance. There's another example I want to go over. Just give me 2 minutes right here. So what's happening is we ordered a TV last Tuesday, and now it's coming in, and my wife's calling me for those things. So yeah, just 1 sec over here. All right. Looks like we have dinner to go to. Risk, Raja's risk management, RM, something I thought of recently, RM. Okay, right? So we're adding, would you wait for the new bullish candle on 15-minute to close before entering again? That's a very good question that I'm just getting to right now. That's a very, very good question, and we're going to address this question. We were going to address this question, but you asked it before I would address it. So let's go over that right now. So let's say, for example, now we're going to talk about the 15-minute, and these situations, man, trust me, they happen all the time. Okay, so we got a bearish candle right over here, and now we have a candle that's closing bullish. Okay, and then and now you're so this is the 15-minute, for example, right? So we're using this same example. We're using this example right over here. So we got the 15-minute and then a 30-minute close like this, whatever, and then the new 15-minute close like this. So now you want to take a buy at this point. When you're trying to take a buy right over here, and the next 15-minute candle closes bearish with little to no wick on the top. And if the 15-minute candle after that starts to break the high, just by studying impulse entries, what are you going to do at this point? Where's your buy going to be? And let me zoom in over here. Oh, I can't zoom in. Let me zoom in by drawing the candles here again. I'm going to draw the candles by zoomed in candles, right? So let's say you have a 15-minute and the next 15-minute closed bearish. Once the next 15-minute closed bearish, this is where you closed 50%, right? You closed 50% because you're like, okay, you know what? I took a buy, but prices closed against me. So I learned whenever a candle closes against me, I got to close 50%. So when you closed 50% and then you see the next candle make a wick down and start to break above the high, and the overall 30-minute candle, let's say the 30-minute candle was right over here, and the overall 30-minute candle now is starting to push up, you're like, okay, maybe I can add an impulse entry as we break above the high for price to continue to push up. Right? This is the first scenario. First scenario is when the candles start to break above the high, which has little to no wick. So you're starting to say that, okay, now price can continue to push up. Second scenario is when you have a bullish candle and the next 15-minute candle closes with a wick, but it's a bearish candle. In this scenario, you're waiting for the 15-minute candle to close and then anticipate the next one to continue pushing up. And you add risk back at the break of the high of the bearish candle. Yes. Right? So this goes back, this goes back to the principles of impulse entries we learned. And the principles were that whenever you have a candle that closes with no wick, it's an impulse entry as we break above the high. But if a candle closes with a wick, then you have to wait for the next candle to close. Then you got to wait for the next candle to close. That's basically the caveat when it comes towards those things. In scenario one, can you talk about your favorite, most profitable trades? Yeah. So let's say you have a candle going bearish and I take a sell and the next candle closes, bullish like this. I close 50%. And when the next candle starts to break the low of the previous candle, impulse entry goes in. And that's adding risk back, anticipating price to continue pushing down. That's it. You're just actually just waiting for price to do the same thing, right? Now, sorry, you're waiting for the candles to close in that same in the same way or the same scenario in the same pattern, and you're recognizing these patterns. And the more you practice and the more you recognize these patterns, the better you get over time. All right. So any sort of issue here? Anything? Static risk is where you manage risk. If a candle closes against you, you close 50%. Dynamic risk is where you initially go in with a lower risk, right? Dynamic risk, you go in with a lower risk, and then dynamic risk has two scenarios, right? As price goes against you, you add a position. That's risky. And then as price goes in your favor, you add a position. That's way more easier. What was it when it had a wick opposed to no wick? Okay, so when you had, let's say, for example, yeah. All right, let's say if we had a wick right here, then you're waiting for the candle to close, right? So whenever a candle, oh, I ran out of ink. Oh, my bad. Whenever a candle closes with no wick, this is only for impulse entries. Impulse entries, it's perfect, right? And whenever you have a wick, whenever there is a wick, when there is a wick, then you have to wait for the closure of the candle. Then you have to wait for the closure of the candle. Very simple concepts. And also whenever let's say you're waiting for this candle to close so you can take a sell on the next candle, this candle can continue pushing down, right? And you can just miss the trade. That can also happen. What do you do in that case? In that case, you do nothing. In that case, you just chill out, you relax, and you literally, you do nothing at that point. You're like, okay, you know what? It's a part of the game. What about a candle opens without a wick? What scenario? Which scenario? Like up, down, bullish, bearish, wick at the top, wick at the bottom? What are you talking about? Any. Opens without a wick? Okay, let's say that this candle opens right here without a wick. Yeah, I don't think you thought the question through, which is why you said any. Then, I don't know, the candle closes without a wick. I mean, then yeah, I'm going to wait for the candle to close. If a candle closes without a wick and the previous candle has no wick, then it's an impulse entry as it starts to break the low. Yeah. And whenever candles generally speaking, whenever you have candles that are, let's say, you're looking at a bullish candle, let's say perhaps, and the candle closes and the candle opens like this, starts to go up, in the first few minutes, 2, 3, 4, 5, 6, 7, 8 minutes, there's a higher probability it may come down to create a lower wick. So just refrain from taking buys like this. Just refrain from that. The initial sell is on a 30-minute time frame, and then you manage to risk and take in percentages on 15-minute time frame. But initially, you want the 30-minute candle to close. Yes. Yes, I follow your thought process, Will. I have answered the most questions I've ever answered to one person has been Will. Will was in Sydney boot camp, And out of all the boot camps, Will is the only person who's asked me so many questions that I know exactly where that thought process is coming from. Yeah, so you absolutely. It's very funny. It's hilarious. Yeah, yeah. So I know where that thought process is coming from. Sometimes you cut losses short based on 15-minute candles. Okay. Sometimes you ignore the 15-minute time frame plus 30 minutes. Can you give us the reasons to do so? Yes. And there are two reasons, right? And I'm going to give you the most simplistic reasons as possible. When to cut losses short on 15-minute versus when to trust the overall 30-minute. That's the question, right? And I'm going to give you a very simple answer to this. I had the same question, but couldn't figure out how to word it. So that's the thing. Okay. So I'm going to give a very simple explanation to this. Let's say your week starts. You're on Monday. You're on Monday, right? You're on Monday. You're on Monday and candle closes against you. So you manage risk. You manage risk. Then you go on Tuesday. You go on Tuesday and you straight up win. And then Wednesday, you straight up win. Okay? This is me talking that you're consistent and you're patient and you're really, really waiting for trades. Now you come on Thursday, right? You Thursday come on as a gladiator, you know? You come on as a gladiator, swinging your sword all over the place, the sword of success. That's the sword of success. You're swinging your sword of success all over the place, and you're like, okay, you know what? I've been winning since some Monday. I managed risk. I lost a trade. Tuesday I won. Wednesday I won, and now it's Thursday, and now a setup has come to me where I'm going to take a trade. So you take a trade. You take a trade, and the 15-minute candle closes. 15-minute candle closes against you, right? And you're like, okay, I won on Tuesday and Wednesday. 15-minute candle has closed against me. So maybe I'm going to trust the 30-minute and I'm going to leave the trade run. That's when I trust the 30-minute. Like if I'm in profits, let's say, or if I'm very, very confident, I'm just going to trust the high time frame. That's so like, that's the only reason when I'm really going to trust those time frames. When I'm in profit. So whenever you're in profit, you can afford to take more risks. You can aim to risk a part of that profit towards the trade that you're trying to risk on. So we don't know. I don't close anything. There's no we. I don't close anything. Because I don't want people come to me tomorrow saying that, oh, Raja, you told me to hold the whole trade and now I've lost the whole trade. There's no we. There's Jason, there's Kevin, there's Mehul, and there's me. We're all different. There's no we. We're not pooling money together in trading. Yeah, so no one blames me. I'm just telling you how I manage risk, and that's, I think, the best way to manage risk. Right? Most of your studying, most of your experience, it's all based on managing risk. You got to manage risk. There's no such thing as no managing, like you have to manage risk. Okay. So since I have your undivided attention, I want to make an announcement. There is a document shared on Slack, right? There's a document shared on Slack, and everyone who's in this boot camp, you guys are going to get a special account on Dominion Markets, right? All you need to do is fill out that document. There's only one trading account that's going to be given $5 per one lot. Everywhere else is $7. So you need to fill out that document to the best of your abilities, and then we'll do that for you. Yeah, they told me to make an announcement and I have to make an announcement. Okay, so what do you say? Let's do like a simulation. We can do a simulation. We'll do a simulation and then we'll see if we have some opportunities to manage risk. I'm going to start a simulation on our this on this MT5 simulator that we have now. So we're gonna test it out. Fake outs we're gonna do tomorrow. What about live? What about live at the moment? Live charts? Let's take a look at live charts over here. Live is, like we had news. So should we wait to complete the document if we are thinking about changing to C Trader? No, no. C Trader is going to be the full 7 lots, the full $7. Can you share the like for MT5 simulation? Link? No, it's not ready yet for people. When will we discuss psychology? Psychology is discussed on day 4. So today we are on day 3. Yeah. All right. Let's take a look over here. GBPJPY. Yeah. Pound yen is just consolidating. Yeah, we're ranging here now. 1 hour time frame, this is a 30-minute time frame. Even if we think that this range 183 till 183, like 183 to 183 700 to 183 600, it's like 10 pips. It's nothing. It's nothing. What I think is going to be better is going to be, let's say, if we create some sort of a support over here, or maybe like some sort of a support over here where a candle closes bullish, then maybe this range 183,660 till 960, which is maybe 30 pips, would make sense. No, it's actually 30 pips right here would make sense. And then you can say the next candle can continue to go up, but they're just waiting at this point. Japan closed Mountain Day. Perfect. Mountain Day. All right, let's move on towards simulation over here. We'll do simulation and then, yeah. All right, so I'm going to let Zoom buffer so that it doesn't take long to buffer. So we're going to send the next meeting in about 5 to 10 minutes. The next meeting link. Everything is being saved at this point. All right, so we'll see you guys in 5 to 10 minutes. See you then.